Hello everyone and welcome to the channel Invest and Grow. Today we are going to discuss about the difference between day trading and long-term investing. Which one is better and why? What is better, trading or long-term investing? Well, this is a question that we hear people ask when they enter the stock market. This is a great question indeed. We always find two types of people in the stock market. One are day traders, who might tell you that you can make thousands of rupees daily by doing trading. The second one will be the long-term investors, who might say that you can invest money for long-term and become a millionaire in the future. So what should we do? Should we do trading? Or should we invest for long-term? In which way can you make more money? Which one has the lowest risk? Well, you have to keep one thing in mind, that trading and long-term investing are situated on the opposite sides of the spectrum, and each of the methods comes with different advantages and disadvantages. Firstly, it is essential to understand what both the terms mean in practice. First of all, let's understand what trading is. Trading refers to a practice whereby investors buy and sell stocks, commodities and other financial instruments frequently, sometimes even in a day. Trading is done primarily for short-term gains. Trading is one of the common features of the stock market worldwide. With trading, investors look to cash upon price fluctuations within a short notice. Long-term investing refers to a strategy where you hold on to your investments for a long period, which is generally 5 years or more. It's one of the ways to make meaningful gains from stock market and equity mutual funds investments, which give the desired results only when you remain committed for the long. To put it otherwise, long-term investing refers to the period until which you hold on to your investment. Now let's talk about the difference between long-term investing and day trading. The main difference is the time. The goal of long-term investing is to build wealth over a long period of time by carefully creating a portfolio of stocks and assets such as mutual funds, bonds and other financial instruments. Day trading, on the other hand, is an approach where the trader buys and sells shares very frequently. The transactions could occur even within a single day. The aim of short-term trading is to earn high profits from price fluctuations within a small time horizon. When you invest for the long term, you can try to minimize the risk of price fluctuations. Plus, through dividends and compounding returns over the long term, you can earn higher returns over a period of time. This allows you to invest small amounts over a period of time. Risks are higher but monthly returns can be greater too. Day traders need to invest large sums of money in order to earn substantial earnings from the small price fluctuations in a single day. This can be a risky proposition, as you stand to lose a lot of money if the trade doesn't go your way. Long-term investors use fundamental analysis to find out a stock's intrinsic or real value. They do so through financial metrics, earnings reports and ratios. Day traders evaluate stock movements through technical analysis. Here, the future value of a stock is determined by using charts and historical patterns. Commission costs can be insignificant in long-term trading since they hold on to a single asset position for many years or even decades. The trader conducts a number of transactions during a single day. This can result in higher brokerage or commission costs for the trader. In long-term trading, you need to carefully pick out good stocks that can grow and deliver good returns in the future. Look out for stocks with high growth potential and good management teams. Since day traders are more interested in quick returns during a single day, they look out for stocks with higher volatility. This way, they can exploit the price movements to make profits. Now let's discuss about the pros and cons of long-term investing and trading. Pros of long-term investing. 1. Compounding. Long-term investing brings compounding into play. Compounding helps generate interest on the interest earned, which helps in creating a bigger amount. As an example, suppose you invest 1000 rupees per share in a company which offers 10% returns per annum. Your investment becomes 1100 rupees after the first year, then in the second year, you will get the profit on cumulative amount of first year, that is 1210 rupees, and so on. 2. Eliminates emotion of the equation. Emotion is your worst enemy when it comes to stock markets. Long-term investing takes emotion out of the equation and helps in making a more rational decision. Small and temporary volatility in the market will not affect your decisions. As an example, suppose the stock market saw a 10% fall in a particular month. A short-term investor might panic. During such circumstances, emotion easily kicks in. Fear and greed might cause us to make the wrong call. This might not affect a person who is going to be invested for a longer period, as he will see the bigger picture and will hold on to patience. 3. Easy to correct mistakes. With a long-term view, you can easily correct your investment mistakes and make the necessary changes in your portfolio. In other words, you get the much flexibility to take corrective steps if your strategy doesn't go as per your plan. This isn't possible with a short-term view. Cons of long-term investing. 1. Risk of losing principal if company doesn't perform as per expectations. If the company in whose stocks you are investing fail to perform as per expectations, then there is an inherent chance of losing the principal amount. Note that when the company doesn't perform as expected, its share price falls and a constant decline results in wealth erosion. 2. Capital blocked for long-term. Long-term trading requires you to invest your capital over a period of time. You might feel that a certain amount of capital is blocked out in one stock which could, otherwise, have been used for short-term advantages. Pros of trading are: 1. Easy and convenient. One of the significant advantages of trading is that it's easy and convenient to execute. If you are well versed with the nuances of stock market, then with the right trading strategy you can make meaningful gains. 2. Quick liquidity. In case you are in need of funds, trading is a convenient route to obtain the same. By selling securities, you can meet your liquidity needs and even overcome a cash crunch. Cons of trading are: 1. Chances of suffering losses. Most investors have the idea that trading is a quick way of making money in the stock market. However, it's not so. If not done in the right manner, there are high chances of suffering losses and losing your money. 2. Leads to timing of market. Sometimes trading leads to timing of the market, which is a poor strategy as no one can actually predict when markets would go up or hit bottom. It is difficult even for the most seasoned expert to predict with accuracy about market movements. Day trading and long-term investing are two vastly different approaches to creating wealth in the stock market. You need different set of skills to excel in these investment avenues. But if you are a beginner, it is always better to start with long-term investments until you gain some experience in the stock market. Thank you for watching. Please subscribe this channel for more similar videos.